Good afternoon. This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group, and we're here with another edition of Energy Markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and a blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone, especially those not intended to listen. Information is not guaranteed to be correct. This is not an offer to buy or sell any derivative. Today is May 16th. Andy Lebow, I usually say it's been a month and a lot's been going on in the oil markets, and I really mean it this time.
Oh, my goodness. Everything's going on, Jim.
We have Iranian sanctions, Middle East, heightened tensions in the Middle East, contaminated crude coming out of Russia. The EIA, OPEC, and IEA have come out with their monthly supply-demand estimates. Where do you want to start?
And you forgot the China-U.S. trade spat thrown in there.
Oh, there's a lot I forgot.
Yeah, there's a lot. Well, first of all, I want to start with just my email address. If you want more, it's alebow@commodityresearchgroup.com. Now let's get to the good stuff. You know, with all you mentioned, Jim, and everything that's flying around the oil markets, I thought it might be good to just start with some numbers like you and I like to.
Terrific.
And so our listeners can really get a better feel for what's happening in the market besides the headline. And, you know, we always like to focus on OPEC as they, for all the reports of their demise, they're still 30% of world production, and obviously are a key factor, OPEC and OPEC plus. So I thought I'd just start with where their production was, Jim, in April.
Okay.
And where I think it's going to be in May and June. They produced, according to their own report, the OPEC report, which I sort of like to use as the official, the official report. Everybody's pretty close to where their numbers are. They use an average of 5 or 6 secondary sources along with their own. And they have OPEC producing in April 30.03 million barrels a day. And that is down from just from December of 2017 of 31.6 million barrels a day. And from December 16, they're down 2 million barrels a day. So they pretty much have adhered to the cutbacks, the deal that they drew with the OPEC plus producers, which mainly are Russia, Kazakhstan, Mexico, the 3 leading OPEC plus producers. One of the main reasons, besides the Saudis cutting back significantly, of course, and we've talked about this in past monthlies, have been the collapse of Venezuelan production, coupled with, of course, the sanctions by the U.S. and also the loss of Iranian crude owing to the sanctions by the U.S. Iranian exports before the sanctions, crude plus condensates, were probably 2.6, 2.7 million barrels a day. The U.S., of course, has now not granted any waivers to buyers of Iranian crude. So we think that it will probably come out to be about 0.5 to 0.7 million barrels a day of imports. Maybe more, maybe less, depending on of exports. Maybe more, maybe less, depending on the Chinese. And Of course, that's a big loss.
Do you have a sense where that is now, right now? Is it?
Well, it was prior to with the waivers, it was around 1.3 to 1.5.
Okay.
So we're about to lose an additional, say, 6 to 800,000 barrels a day of Iranian crude, owing to the second, the tightening of the sanctions. That's a lot of crude.
It is a lot of crude.
And now, OPEC Plus, which is basically Saudi and Russia, plus some of the other ministers, are meeting this weekend to discuss what they're going to do. It's pretty clear that they can make up the loss of that 500 to 700 a day. However, and that'll come from Saudi, maybe the Russians, but we'll talk about the Russians having their own problems. The Saudis, can easily increase production. In fact, they're at 9.8 right now, 9.8 million barrels a day, relative to what they're supposed to be producing, which is 10.2 million barrels a day. Under the 10.331 actually is the baseline. So there's room for Saudi to go up and still adhere to the deal they did with the Russians last year. And I think they probably will. It's just a question of, how quickly they increase production, and they're not giving any indication that it's going to be it's going to be like this month, May and June. And Russia has issues with contaminated crude coming out of their pipeline into Europe. They too can increase production.
Let me just go back. You said there's a meeting this weekend, and that's
the monitoring committee, but they're going to talk about Iran.
So is it possible that the Saudis come out and say we're going to increase by 500,000 coming out of this meeting, or are they going to wait till the June?
There may be chat coming out of this meeting. It's possible.
Right. Yeah, you never know now.
You never know.
Yes.
They have a whole different way of communicating.
Yeah.
So it is possible that they say they're going to increase, or they may say, if the market wants crude, we'll give it to them,
right,
and not say what they're going to produce. All right.
So
go
ahead. Sorry.
There's a key factor in all this. Okay.
Yes. Yeah.
All right. Here's the key factor. Saudi can increase up to, let's say, 10.3, and UAE and Iraq and Kuwait could throw in a little bit more. But it only is going to get back to the 30 or 30 and a half million barrels a day of OPEC production. Okay, 30 to 30.2 maybe. Now, that's great, but demand for their crude in the second and third quarter is going to be like 30.6 or 30.7 million barrels a day.
Right.
So Saudi can replace Iran easily.
Yes.
But it still leaves a global deficit in second and third quarter.
Right.
So the fundamentals, and that's against a backdrop of inventories being only slightly above normal. So it isn't like we're fat and happy on inventory. We're not. We're normal. We're okay. But we're not brimming in inventory.
Right.
So
yep. Before we go on, I just want to mention OPEC has been getting sort of help from Venezuela going down, and they're now, I think in that OPEC report they're showing 768,000 barrels a day,
right?
Which was actually up a little bit from last month. So, that's kind of bottomed out. We're not going to see any more decline from. I mean, they're pretty much at rock bottom. But
I think 700 to 800 is where they're going to be for a bit here. Could they go lower? Yeah, they probably could go lower.
And also we also always throw in Libya and Nigeria as big question marks. But Libya last month was 1.176 and Nigeria is 1.8. So, I mean, that at least they're not declining as well.
Well, for now, I mean,
for now.
For now, there's a civil war going on in Libya, so
right.
It's certainly possible that they go lower. Trump reached out to General Hadar,
Yeah.
probably to talk about, don't mess with the oil supplies. But
Yeah.
yeah, who knows? I think the key thing, Jim, we're at a big deficit, right? And the market seems to say, well, the loss of Iranian crude is no big deal because the Saudis will make it up. Yeah, that's right. But they're not making it up to where there's going to be any kind of surplus or even bad, unless everything changes, and they blow the deal up. But I don't see Saudi doing that because they're
Right.
pretty happy with the prices here.
Yeah, that's right, and it definitely when you look at the supply demand balances coming out of those 3 monthly reports, they look balanced but tight as you go through the year. Am I reading that correctly?
Yeah. Well, fourth quarter looks like it's going to loosen up.
Right.
So, but Q2 and Q3 look very tight, and Q2, now the maintenances are basically ending. The end of May or into June, all the refinery maintenances in the eastern and western hemisphere are going to be basically over. So we're really going to crank runs out now. Starting now. Actually, starting now. We're gonna be banging runs out, and we'll probably be drawing a lot of crude coming up. And you know what, Jim?
Yes.
The market is indicating that in the Eastern Hemisphere. Those crudes are going wild.
They're going wild.
They're
Yeah.
going wild. The physical market is so tight. The Brent market is backwardated. The front is higher. The front is higher than the back.
Right.
And Brent's the front, like the first month of Brent physical is $1 over the second month. 40s is $1 over.
And that's up from, say, a couple months ago.
Yeah, when it was flat or under.
Right.
When Brent was contango. So, and the Asian crudes are very tight. And US crudes, you look at you look at the port crude, the offshore crudes like LLS and Mars, they're going nuts. They're way backwardated over, they're way over WTI. WTI is probably the only thing that's contango.
Yeah, and that's because we have more of I don't want to call it a stranded asset, but we're filling up Cushing more. Is that? I mean,
yeah, Cushing stock, global U.S. stocks, of course, have increased significantly over the last couple of weeks in the Mid-Continent and also in Pad 3 as well as and Pad 5. But yeah, the front is carry is contango, where the second month is higher than the first month.
And that's just waiting for the refinery runs to come back.
Yeah, exactly. Exactly.
And also the increased production in the U.S.
Right.
Expected, I guess.
Yeah.
I just want to mention, the stock, oil market's up today, stock market's up today. The correlation is about plus 0.46, which is, if you look at oil and say diesel and gasoline on the futures markets, it's about 9.90. But this is the second highest correlation is the crude with the S&P. And I'm guessing that reflects the global demand issue. Do you want to talk about that for a second?
Yeah, let's talk about that, because that's really that's just
as I lob one in there.
Yeah, you totally lob one in there, because despite the fact that there were Saudi vessels hit in the Persian Gulf and the facilities were attacked, the market somehow went down on Monday, in sympathy with the global sell-off. And the reality is that demand has been good.
Right.
It's been good. It's not, it's not being choked off.
The IEA shaved about 90,000 barrels a day off the year, but it sounds like they were looking at a slower. I think what I'll quote them and say slower demand in Q1 is short-lived.
Right.
That's what that 90,000 was about?
Yeah, I think that is what that 90,000. They're still expecting strong petrochemical demand. Distillate demand is actually been pretty good. Diesel
Yes.
demands are good, and we've got this IMO 2020 staring us in the face for later in the year.
Yeah.
So
It, I, I, it's interesting. We're talking about the rising tension in the Middle East. There's actually been attacks on the shipping and the pumping
right,
stations,
I know.
and volatility is gone down. So I mean, it's there's that tendency of option vol to move with price. So as price goes down, vols go up. As price goes up, vols go down. But during middle tensions that may actually escalate, you would think that it would hold its own or move higher. But
Go higher. Yeah.
yeah, so it's at sitting at 26.4. We came into the year in January at 53, got down to around 22. Then as prices came off, we got up to 30, and now we're at 26.4. So that's kind of saying, well, it's not going to escalate, is what it tells me. But
right, and I think most analysts and traders and or don't think that it'll escalate, but nevertheless, you saw, there were actual attacks.
yeah,
So we'll see. But getting back to on the demand side, so the market sells off broadly, along with on risk off days.
yes,
And, the reality is that it's unlikely that demand is going to fall more than, like the IA had it down 100,000 for the year. I mean, the most I could see is 200 or 300 maybe, a day. I think the market continues to, it overreacts.
it does.
It completely overreacts on the downside, which is, I guess, not that unusual, right, Jim? That it will overreact the downside. There's a lot of new length in the market,
Yeah,
and I think that's one of the, that's one of the reasons.
Yeah, we're up at in the equity markets, we're at record highs. So even if you didn't have the trade war going on, you might expect a little pullback. But I always talk about this oh my God world that we live in, that things seem to be stretched in both directions a little further. But and like I said, in the option world, we didn't get the oh my God world. We got the
No,
ho hum.
which was really sort of strange.
There's so many cross currents going on. It's hard to tell. So today stock market's up, oil's up, but why is oil up? Maybe they're saying because of the rising Middle East tensions. So
right, man, maybe, yeah, and probably some risk on again. I'm not sure, but I think oil, as I've tried to explain on its own, the
fundamental.
fundamentals look bullish here in
Yeah.
the intermediate term. Plus, we've got global tensions in the Persian Gulf.
On top of that,
On
yeah.
top of that, it's
So,
not really a recipe for going, wanting to go short, except, if you want, from a hedging standpoint. And I think we're probably seeing some of that hedging going on in 2020 and 2021.
So let's just say, and I don't know if it's going to happen or not, but let's say the Saudis come out of this meeting this weekend and say we're going to add another 500,000. Market comes off. You're suggesting that even with that, the fundamentals are still tight. This market's not going to fall apart.
Yeah, even if they came out and said that, if they said they were going up 1 million, that's a different story. I think the market really expects that over the next month or two, the Saudis are going to get up to 10.2 or 10.3, which again is within their deal.
Well,
And the Russians, that they have capacity, but they've got, so as I mentioned, they have some issues with the pipeline, with exporting crude into Europe, uncontaminated. The crude was contaminated,
right.
which they're going to fix, but it's going to take months.
Yes. Well,
And
to borrow an EIA. Let's see, it was EIA, I think. It's a quote saying the supply response will take months. The Iranian disruption weeks, and of course there's a Russia disruption as well. Will take months. So it's kind of like all this stuff has a time element to it as well. So, but again, all this kind of feeds into your market's going to get very tight going forward.
yeah,
Short term.
right, and the physical markets, are indicating that.
Right.
They are tight. They're already tight, and they
They're
could
already
get
tight.
tighter. Yeah,
Yes.
they could get even tighter. I mean, Brent is really seriously backwardated, and they're heading into maintenances in the offshore. The crude maintenances.
Right.
But nevertheless, runs are really about to spike.
Now, the EIA also upped their U.S. production for next year by 300,000 barrels a day.
Right.
So that's no help.
Yeah, I mean, it's not. Yeah, it's next year. It's 2020. Although they have, for 2019, they have crude up like 115, and then another 600 from NGLs. So they've got like over 2 million barrels a day increase for this year, and a lot is going to be in second half. Supposedly, the IEA I don't think is quite that big of an increase for U.S. Crude, U.S. liquids, but they're up about 1.7, 1.8. And that's where I was saying in the fourth quarter, things look like they could loosen up some, possibly if these numbers if this comes, we're at 12.1 right now, I think, on U.S. production, and they're saying it's going to get in fourth quarter, it's going to average 13. So we're looking at a 900,000 barrels a day increase, Jim.
Right.
You're like, we'll see if they come, if that's what's happening. The rig counts don't indicate it'll be that big of an increase, but
is that increasing takeaway capacity too, right?
And this increasing takeaway capacity, which should help. Exports will be higher, and the Midland, which right now I think Midland's trading $3 under WTI, and which would be WTI in Houston is $8, so it's $11 differential.
Mm.
And that'll narrow in.
Nice if you have space. If you
have
access,
you're
a brilliant trader.
You're a brilliant trader. Well, as we've said many times, right? Some guys' whole years are made because they had storage, right, in a contango market, right?
Yes.
Right.
Yes.
Backwardated market, it doesn't really help you that much.
I just want to go back. The OPEC report in 2019 showed a call on OPEC oil of 30.6 for the year, which is down 1 million from last year. And they're, obviously they have the U.S. up, but they also have that Brazilian number. We've talked about this before, of up 300,000.
Right.
Which we have the, I don't know about the inquiry light on, but we're, do you think that's a possible number? Is that going to happen? Brazil?
Well, you know what? If you look at their infrastructure and the new FPSO facilities that they're opening in the pre-salt, it should, it could, it really could, but
yes.
Jim,
yeah, we've seen
that not coming, and that's a big number. That's a big number. They really if they don't come through, that's another, obviously that's a pretty bullish factor. And all these calls are based on the U.S. coming through. When we talk about what's the demand for OPEC crude, it's also accounting for what we're producing.
Right.
Because we're displaced, that 1 million barrels a day is U.S. displacing OPEC.
Yes. Yes. Okay, let's move on to gasoline. Can you just quickly give us the what's been going on there with the supply demand stock level stuff, and then we'll look at
gasoline. What an interesting story. I think a few months ago, at the beginning of the year, gasoline just looked horrendous, and it looked like there was no hope for gasoline. Inventories were really bloated. Demand was lackluster at best. This is U.S.
Right.
And in the last few months, gasoline inventories have drawn sharply, much more than seasonal, because refiners have been unable really to get to, they've taken longer turnarounds, probably in preparation, partly in preparation for this IMO 2020. And there've been issues, things have gone where there've been flooding, flooding in the Midwest, storms in Texas. I mean, there've been issues and operational issues. So we haven't really made as much gasoline as we had thought we were going to make. And as a result, stocks have drawn.
Right.
And right now, gasoline, we look at days supply, which is a good handy indicator for, how well any product is in inventory, where they're at. And gasoline right now is 24 days supply, which is inventories divided by demand. The 4-year average is 25 days supply. So we're into the season on a real low end for gasoline. Now that's going to change because we are eventually going to get our runs up, and gasoline is probably going to flatten out and maybe start building a little bit coming up. But we're still a little, we're still below where we should be on crude runs and on gasoline production. The other thing is apparent disappearance is not bad. It's
Right.
not great. I mean, it's improved from earlier in the year. But so gasoline is I think been, the cracks have really done well. Cracks being gasoline prices versus crude prices. They've rallied nicely over the last few months with this gasoline draw. So gasoline, U.S. gasoline went from looking, absolutely awful to, looking good as a leadership, almost providing leadership.
What does the price curve tell you? Is it expected to continue for a while, or what's like the front of gas?
Well, that's always hard. That's always tough because of the change in, the change in specs.
Yeah.
So typically the gasoline curve doesn't tell you a whole lot, right? Because we got March, April, and
right.
September. So
it just flip the specs flip. Yeah.
Yeah, the specs flip.
So, but you're saying that runs coming back will probably.
Yeah, it's going to flatten. It'll flatten
loosen it up a little.
It's going to flatten gasoline out. Exports have been pretty good too, but I think it'll flatten out, and we'll see. I don't think pump prices are high enough really to make that big of a difference yet.
Mm-hmm.
If they were to go much higher, then maybe there'll be some demand effect.
There's a lot more people at work in the U.S. than there were last year.
And that's a great point, Jim. So maybe, maybe that's helping the gasoline demand. So, what's going on in the options world, Jim?
Well, funny you mentioned that. I want to say not a heck of a lot, but it's we're tracking the the average daily volumes by month, and March dipped to under 100,000 per day, and April came back to 133,000 a day, and it looks like May might be running around that number, maybe a little bit higher, but it's a pretty balanced market. I mean, there was some June 60 put, a flurry of June 60 and 55 puts were bought, good, over 10,000 contracts. But other than that, it's hard to find, and those go off tomorrow. But it's hard to find big trades going by. It's spread out. The most open interest is the D60, the G60 call, the D's 50, 55 puts, the June 55 put, and the June 60 put I mentioned, all with about 30,000 open interest. And, so it's, those aren't big, they're good numbers, not huge numbers. Volatility I mentioned is 26.5, which is kind of, it's kind of, to me, it's kind of on the low side. But if you're looking at a market that's balanced, that makes sense. But if you're looking at an uptick in the Persian Gulf tensions, that could be quite low. So, and my bias is always I don't like selling options. What your chat today suggests is a put selling type of strategy. I think a sideways to higher moving market. Is that what you're looking at?
Yeah,
Yeah,
I think so.
yeah,
I'm trying to think what would change that. And
right.
I guess it would be, yeah, Saudis increasing by 1 million a day would certainly change that, or
Yeah,
maybe releasing the reserves. But there's really no need for that yet. Doesn't
yeah,
mean anything with this administration, but
right. And they're gonna, you had the sense after what happened last year, where they, expected Iranian sanctions, and they got waivers instead. That they're going to wait and see. I mean, that's what I would expect. But yeah, I've been wrong a few times over the years, so we'll see how
no.
that we'll see how that plays out. So getting back to what about distillates, Andy? You got this, 2020 IMO fuel standards coming up, and what are we seeing? What are you looking at?
Well, distillates distillates were running on, again, look at those days supply, quite a bit. Earlier in the year, distillate inventories were really, late last year and early this year, distillate inventories were really pretty tight. We were running as much as 5 days behind the 4-year average. And now we are basically only 1 day behind the 4-year average, and we're ahead of last year's numbers. Last year, distillate was tight all the year. There's a lot going on with the IMO 2020. Refiners, blenders, shippers all have to, figure out what they're going to make, and how they're going to make it. And we'll see whether or not distillate inventories, there's some talk that refiners want to start building middle distillate inventories in anticipation of the change in spec, which is away from a high sulfur fuel oil to a lower sulfur gas oil, 0.5%. So it's really a new spec, and it's going to mean demand for middle distillates is going to increase. There are all kinds of numbers flying around by how much it is. It'll probably be less than what people think, because the markets are preparing for it. It's been since they've known about it for 2016, and now they're preparing. So we'll see if if middle distillate stocks increase. We'll look at the yields, whether or not these the yields increase. They're beginning to, at the expense of gasoline, which could be supportive for gasoline later on. So the the middle distillate market is going to be very interesting coming up over the next few months.
Yeah, it's I did this guest lecture a few years ago, and I was talking about optionality that naturally occurs in the business of oil, and I was talking about the airlines. If they have a flight where they short flights, hops, where they go from one city to the next, and faced with three different jet fuel markets, and I was thinking more of like Europe, and they have the ability to top off their tanks. There's a little sort of tolerance there that they can play that option. And after the class, this guy came up to me and he said he was on a cruise, and they pulled into this port. There was nothing going on there, and he asked, why are we stopping here? And the guy said it was the cheapest fuel around. So I'm wondering if that option goes away with these new standards. But we'll find out.
We'll see.
We'll
Yeah,
see.
we'll see. The shipping industry has installed scrubbers.
Right.
They
Right.
spent millions on that, and I think it's really going to be blending it and making sure they're at the ports where they need to be.
Right.
That this fuel is at the right fuel is at the ports.
Yes.
So it's a massive undertaking
It's a massive undertaking.
by
Yes.
the industry, because you're
Yes.
looking, it's 4 million barrels a day of demand is affected. So it's it's big numbers.
So, Andy, I think we kind of covered a lot of stuff here. What did we miss? Do you want to say anything else that we
No,
want
I
to talk
think
about?
I think we
We're
I
good.
think we yeah I think we covered a lot. There's still obviously there's a lot. The second half of the year is going to be a doozy. I think.
Yeah.
Yeah, I mean, I think we've been pretty constructive towards this market
Yes.
consistently, and it's with with drones flying and ships being attacked. Chip, what would this have been like?
Well, I did.
Years ago, we would be going crazy.
I remember the first Intifada, Andy, where oil markets, vols blew up. That people got really nervous, and all of a sudden, people realized there was no oil in Israel, and but the markets reacted to
The
it.
markets reacted, yeah.
And now we have some actual attacks going on, and the market's reacting, but it seems
Muted.
very muted, subdued, yeah. So
Yeah.
okay, commodityresearch.com.
Commodity Research
Group.com.
Group.com.
Thank you, Andy. That's us, and we hope to hear from you, and we'll see you next month.
All right. Thanks, Jim.